Good morning, everyone. Thanks for joining us for the spring edition of the Naviga Fund Talk session. We apologize for a bit of the technicalities this morning. We had some issues on the invites, so apologies for that. But we've got an exciting session ahead. We are joined today by Adam Furlan from 91. He's a portfolio manager as part of the fixed income team at 91, looking both at local as well as the global side of fixed income. But today we're going to be focusing specifically on the 90 Global Diversified Income Strategy. You'll likely be familiar with this fund, incorporating it more and more across the Naviga range of portfolios. Provides that low duration, flexible income exposure with a very, very attractive yield. Adam, you can correct me if I'm wrong, but I think we're sitting at around gross yield of 5% in dollar terms at the moment. So a very attractive yield, especially in a very uncertain environment. The volatility that we see offshore at the moment, and potential slowing in growth indicators. Even though equity markets, despite that, equity markets are still scaling new record highs. We've got a lot of monetary policy uncertainties in markets moving around the expectations of rate cuts and central bank independence, which has been a big question the last few weeks. So it's a great time for update on the and Adam for your views. So we appreciate your time today. As always, if there's any questions, please pop them in the chat box. I'll get to them at the end. Then, yeah, that's it for me. Adam, I'll hand over to you. Thank you so much, and share your thoughts from your side.
Thanks very much, Eben, and good morning to everyone. Thank you for joining me on the call this morning. I'm going to provide you with an update on our local macro outlook from the South African local and global fixed income teams here at 91. And as Eben mentioned, I'm a portfolio manager in the teams on the 91 global and local diversified income funds. So let's get straight into it. I'm going to start with the local South African macro outlook, then move on to our global outlook, and conclude with portfolio positioning on both strategies. Starting with the local macro factors, looking at inflation in South Africa, we have been in a very benign inflation environment over the last 12 months in South Africa. You can see our average expectation for 2025 is for headline inflation to average 3.4%. That is premised on a average rand price for the year of 1820. As you'll know, this morning, we're trading at 1770, quite a lot, about 2 to 3% below that. And in terms of our oil forecast and the numbers, $68 Brent per barrel, pretty much in line with where spot levels currently sit. That has given the SARB room to adjust policy somewhat. But as we know, and as a lot of market participants may feel somewhat frustrated with the speed or the magnitude of rate cuts that we have seen, the SARB reduced it reduced the repo rate to 7% at the July MPC. And alongside that MPC rate cut that we received, more importantly, they announced the shift in their focus of the within the inflation target range from 4.5% to 3%. So what does that mean for front-end short-dated interest rates, or what does it mean for monetary policy going forward? Quite importantly, we are at the bottom of our inflation cycle. The most recent headline inflation print has printed at 3.5% from a low of 3 in the second quarter of this year. And looking at the chart on the left-hand side, you can see that peach line being our CPI forecast. We forecast inflation to head back towards 4 and north of 4% over the first half of next year. The SARB is now focused on moving expectations lower, down to 3% from 4.5% where they currently sit. And we believe that they will be successful in doing so. But in doing so, that means that they're going to have to talk tough on monetary policy, talk tough on how they will react to future inflation, upside surprises above that 3% level. And, for us, that means that the SARB is likely going to be on hold at the September MPC meeting. If we do see expectations react quickly over the next, we will receive inflation expectations data over the next 2 weeks. If that shows meaningful downside, the SARB may have room to react and reduce rates one more time this year. But our base case is for the SARB to be on hold over the remainder of this year. Looking forward into next year, what does the change to 3% inflation going forward actually mean for bond markets in particular? Currently, if you look into our longer dated, fixed income yields in South Africa, longer 10-year government bonds in South Africa trading close to 10%. If you go further than that, yields are just 10.8% in 20-year government bonds. Those assume longer-term inflation of above 4.5%. Those yields price in inflation of 4.5 to 5.5% over the long run. So if the SARB is successful in shifting inflation expectations meaningfully down towards 3%, and we believe they will be, that means that there is a significant amount of upside in longer dated fixed income securities in South Africa. What else is priced into those longer dated fixed income securities? It is credit risk. And here, as we all know very well, the debt to GDP profile of South Africa has deteriorated significantly over the recent years, particularly since COVID had a large impact on the GDP outlook for the country, and the debt dynamics moved significantly higher in response to that. Where do we stand today? We currently sit at a debt to GDP ratio north of 75%, and what is the Treasury doing about it? If you look to the right-hand side, we have delivered primary surpluses. The National Treasury has delivered primary surpluses over the last 2 years of 0.5% of GDP. So that is the 23-24 fiscal year and 24-25 fiscal year. Looking at the 25-26 fiscal year, the Treasury is forecasting a primary surplus of 0.9%, so close to 1% of GDP. That's about 60 billion rand. And they are on track to meet that target. Revenues are performing in line with, or close to in line with what was set out in the final budget that we eventually received in May of this year. So the outlook from a fiscal perspective is quite positive. Most global economies are forecasting deficits. If you think about the US, Europe, all of these countries are projecting wider deficits going forward. South Africa is in an austere fiscal environment, being tight on spending and actually showing these surpluses going forward in an attempt to reduce this debt to GDP profile. To the left-hand side, what is really important in reducing that profile? It is growth. And a 3%, a 3% growth rate, the black line on that chart on the left, moves that debt to GDP profile lower quite quickly. But as you know, our forecast for this year of 1%, looking forward, we see potential, just below 2% going forward. The reform momentum is not yet in a place to actually deliver, that 3% growth rate that we need to meaningfully reduce this debt to GDP target. So that remains a concern for the fiscal outlook. So what is happening on the reform side of the ledger? Operation Vulindlela, is the main thing to watch in this space. We've released phase 2 in May of this year, but phase 1, was actually quite a significant success. So, let's take a step back and think about what happened. What did Operation Vulindlela phase 1 actually focus on, and what did it deliver? So phase 1 was, reforms in the energy sector, the logistics sector, the water sector, as well as the telecommunications sector. Talk to visa reform also fell under phase 1 of OV. So what was the outcomes of those various, reforms that went through in phase 1 of OV? In the energy sector, the main reform that happened there was the opening up of energy generation to the private sector, and the limitations being moved on that made a significant impact to private sector generation. As we all know, what that did was lift constraints on electricity to the economy, and actually was the major part of investment unlocked under phase one. Over 500 billion rand of investment went into generation capacity as a result of those reforms in the energy sector. And as we all know and experience today, load shedding is a thing of the past. Eskom's just reported an energy availability factor north of 70%, and that is because demand actually has reduced on Eskom generation, particularly because of the private sector generation that is supplementing that. But looking at the other parts of phase one, telecommunications spectrum auction went ahead. It was successful, and if you think about the cost of a 2 gigabyte bundle of data, that has halved in price over the last 5 years. So data costs are significantly reduced. That increases efficiency and productivity in the economy. If you think about the water sector, not the retail water sector, not at a municipal level, but at a corporate level or at a industrial level, to wait for water licenses in the mining sector, in the agricultural sector, that used to be a north of 1 year process. As we stand today, those waiting times have improved from 360 days to 90 days, and that is a significant unlock and improvement to the ease of doing business in both mining and agriculture. Finally, as we all know, on visas, visa reform has improved and buoyed tourism, a big boom to the Western Cape tourism in particular, and that reform has resulted in increased numbers being seen at our airports and ports, and has resulted in job creation in that tourism industry, which has actually been in quite a boom in tourism over the last over the post-COVID era. So finally, the one that remains the biggest concern and the biggest constraint to growth in our economy is logistics and rail. And ports and rails currently is the focus of OV. It is being managed from within the presidency. There's a specific task force tasked with sorting out issues and bottlenecks at Transnet in both ports and rails. Minister of Transport Barbara Creecy working very closely with Rudy Dixon, the presidency, to unlock capacity on our ports and rails. And what have we seen in that space? We are starting to see some improvements. More recently, the list was announced of more than 20 plus private sector participants that have bid to operate on the rail networks. These are, we have these skills in South Africa. The companies like Traction, like Grindrod, are currently operating on government-owned infrastructure across the African continent. It is a model that works, and it is a model that we are looking to implement in South Africa. Once those bids are processed and ultimately the contracts are finalized, we will have third-party private sector operators on our rail network going forward. We expect that to result in an increase in rail volumes. That means we can export more of our minerals, externally, and that will be a significant growth unlock. What does phase two focus on? It is a continuation of progress on that logistics sector, and then a focus on the municipal water, the water sector in specific, which is providing quite a constraint to local government and local business at a municipal level. Those are areas that still have a lot of work to do. OV releases progress reports quarterly. This is the first thing we read when they come out, as this is the area where we can unlock growth in this country. At the moment, not enough has been done to improve potential above 2%, where we currently view it. But if this momentum continues, we believe the forward-looking outlook for South African growth actually is quite positive. What is happening in the SOE space? Eskom, the worries about Eskom, we used to see it in the headlines every week in the newspapers. Eskom is no longer a concern. The reform momentum in that energy sector has worked. The unbundling of, the three entities within Eskom has happened. And the next thing we look for is the constraints actually lifted in the energy sector. So the constraint from generation has been lifted, but transmission is the next constraint. Should we get to potential growth north of 3%, that is, we don't have the transmission network to handle that capacity. So, over the last 5 years, 5 to 10 years, we've had renewable energy bid windows coming through. The private sector it was opened up to the private sector to bid to produce energy in the renewable space and supply to Eskom with offtake agreements. Going through that exact same process, the Eskom has opened up, bid windows for the transmission network for private sector companies to own and operate transmission network and to provide that service to Eskom Transmission Company. That was a very successful in the renewable space. That was a very successful project, and we are watching closely. We expect it to be successful in the transmission and improve the capacity within our transmission network. SANRAL, actually one of the better performing of the three SOEs on the slide in front of you. We've seen more road network being granted to SANRAL to manage from various municipalities because of the, actually decent job SANRAL has been doing on its road network. SANRAL has been paid back for the Gauteng roads project or the e-toll project, and that was a political decision, not SANRAL's fault, and ultimately their financial status has improved as a result of that. And going forward, SANRAL is actually a reason to be quite optimistic on the construction sector. We're seeing, the likes of Robex, the likes of Aveng, some of the construction companies in South Africa, their order books actually looking quite healthy because of various road projects coming through from SANRAL over the course of the next year, and we think that will add about 30 to 50 billion rand of investment over the coming 2 years of additional investment in our roads network. Transnet is the big issue we are focused on. The government, the National Treasury has provided Transnet with over 100 billion of government guarantees that secures them over the next 5 years in terms of their redemption profile. And now it is up to the team within the presidency, the finance ministry, and the new CEOs at Transnet, the new management at Transnet, to drive forward the reforms that allow private sector participation in both ports and rails, and we are seeing good progress being made in that regard. What has that progress been? If you look to the middle charts here, we're looking at the amount of volume going through our rail network, which is fully managed by Transnet. You can see that in 2023, that bottomed at 150 million tons from highs of north of 250 million tons in the early 2000s, and that significant deterioration in performance at Transnet result due to a few issues. One being security. Theft on rail networks. We've seen improvements in that regard. Private sector already helping Transnet in improving security on various rail networks. The Richards Bay, the Northern Corridor coal line, being a big beneficiary of that, as those coal mining companies in the private sector actually aiding in security on that rail network, and we've seen much improved volumes on that northern line. As a result of that. Secondly, functioning of locomotives, rolling stock, that has not been well managed. We all remember the saga of incorrectly sized, the incorrectly sized locomotives for the rail network. Also, the issue with the Chinese provider of those locomotives. What was the solution? Actually, as we all know, China often copies technology from other countries across the world. And funny enough, we were actually able to procure parts on those locomotives from Europe that fits and worked perfectly well for the locomotives we had procured from China, and that reduced and stopped the rot and stopped the decline in volumes on our rail network. As you see, 23-24, it bottomed. We actually have already seen or expect to see a pickup, estimated 165 million tons going through the network over 2024. And Transnet has set themselves some very ambitious targets over the next 5 years. We are skeptical whether they will reach that 250 target they have set for themselves by 2030. But good to see that they are expecting significant volume increases as a result of security and operational improvements on that rail network. To the left-hand side, this is private sector generation initiatives, and it hasn't stopped. Despite the fact that obviously we've solved the load shedding issue, there's still a forward-looking growth outlook in this economy. We are going to need better energy supply. And you can see private sector generation expectations is to add north of 10,000 megawatts over the next 2 years across predominantly PV and wind. All of these things are going to drive investment. And to the right-hand chart, that is what we are really looking for to see upside to growth in this economy. We had originally expected a lot of that investment to come through earlier in the second half of this year. It is definitely coming through slower than we previously expected. But investment is a major driver of our increased forecast for next year. So we have 1% GDP growth forecast this year. Next year, we expect an improvement to 1.6, 1.7%. That is as a result of this investment coming through in both the energy and logistics sector, in particular, driving private sector investment and South African local GDP growth. Moving on to the global outlook, and I always like to ironically start the global outlook with our view on the Rand. Why has the Rand been so well supported over the last over the course of this year? Despite the volatility we had around the budget, which drove a little bit of instability, resulted in a loss of confidence, which caused some Rand volatility. You can see that in the chart in red, that dip in the currency. This is inverted, so down in red means a depreciation of the currency. But since that volatility around May, what we've seen is a very strong and stable currency. And as we sit today, south of 17 Rand 70. The black line that you're looking at there is our terms of trade. So that has been a significant driver of Rand performance over a long period of time, and more recently has been a driver of Rand strength. And what that terms of trade is ultimately the price of our exports minus the price of our imports. So what are our major exports and what has been going up in the basket? Gold and platinum. Gold and platinum group metals have been performing extremely well over the course of this year. Predominantly in response to a weaker dollar, concerns over U.S. federal independence and what that means for U.S. debt sustainability going forward. But that has meant gold has been a switch out of gold has been in strong demand over the course of this year. That has been an improvement to our terms of trade. Speaking about oil is our major import. So that, and oil prices have been very stable over the course of this year. In response to weakening or subdued growth globally. So demand for oil has not grown in particular, and actually OPEC has been increasing production quite steadily over the course of this year. That has meant oil prices have been particularly stable, apart from a minor disruption during that very short war we had between Iran, Israel, and the US, which was put to bed quite quickly. Oil prices have been stable over the course of this year. All of that has meant our terms of trade have been improving. And that means that our export basket looking quite good. It means more dollars coming into our country, more, as we export these commodities at higher prices. That has meant rand stability over the course of this year. Add to that, a weak dollar environment. We have been in an environment where US exceptionalism is being challenged. US growth is expected to slow. And that has meant, demand for dollars has declined. That has been a good environment for emerging market currencies as a whole, and the rand has benefited from that trade as well. So focusing on, the three major economies globally. On the left-hand chart, you can see, expectations of, growth versus trend on the vertical axis, and then inflation versus target on the x-axis. So as we all know, we've come through, a significant global change, being Liberation Day in the US, where we saw tariffs imposed on the full global economy. Things have played out quite differently to what people expected on that first day in April. But what has happened to consensus forecasts for growth globally? You can see all of those arrows have moved lower. So all three major economies in the world are expected to have growth below trend, with the US and China actually being the most significant, and Europe to a lesser extent. But all have moved from, a higher position to having a downgraded growth forecast. Then on the inflation outlook, I think, the contrast between Europe and the US is the interesting one here. European inflation actually running below target. So European inflation is forecast over the next 12 months to drop below their 2% inflation target. That means the European Central Bank has actually room to even cut further, despite the fact that they have already cut to neutral in that economy. They are expected to be on hold next week, and we expect them to be on hold next week. But bear in mind, there is room for stimulus there because inflation is well behaved in the European Union. In the US, not quite the same. You can see inflation is expected to be running 1% above target over the next 12 months in the US. You can see that reading that off the x-axis. And why is that? That is because, tariffs are going to drive goods inflation higher in the US, as the US consumer is the one to pay for the tariffs being imposed on the US trading partners, not what the Trump administration would have you believe, that other countries are paying those tariffs. That's not quite true. The US consumer is going to take, we think, 2/3 of that tariff is going to go on to US consumption, and that is likely going to impact US inflation to the tune of 1% over the next 12 months. Looking at the chart at the right-hand side, the fact is that, despite these growth downgrades, despite, that inflation uptick in the US, this is showing, a survey of what the market's fears are, and, green being the soft landing, element to, the market's expectations. So you can see in April of 2025, the market was expecting 50% of a hard landing. They were expecting the trade wars to drive, a hard landing, a big recession in the global economy. Fast forward to July of this year, the last time we have data from this survey, and those hard landing fears or recession fears are back down to 9%, back down to historic averages of recession probabilities. So no one is actually expecting a major recession over the coming 12 months. People do expect a soft landing in the global economy. That is quite good for that has been very good, and the reason why risk assets have performed so well over the recent period between April and September, where we sit today. So what do we believe is going on in the US economy? The jobs market is the thing to watch. We get payrolls data later today. It is a coin flip. That data is very volatile. We've seen major revisions. We've seen Donald Trump remove the head of the statistics agency, the Bureau of Labor Statistics in the US. A lot going on there. But as you can see, that 3-month payroll growth has slowed. The chart on the left-hand side is showing 3-month a 3-month moving average of payrolls, excluding private education, health, and government employees. And those are the three sectors artificially keeping that payroll data a bit higher than expected. That has all slowed quite meaningfully, and we saw large revisions to the data at the last payrolls print. That shows that the labor market is softening, and that means that the Fed should be reacting to a slowing demand for labor in the US. But the Fed talks about unemployment, and the unemployment rate has remained completely stable at 4.2% over this whole period. So how can unemployment be stable with payrolls dropping so significantly, with the amount of jobs being added significantly reducing from north of 500 in 2022 down to 50,000 per month in as we sit today? That speaks to the immigration policy in the US. And to the right-hand side, the chart here is showing you the break-even level of jobs. So this is showing you how many jobs is required in the US economy per month to actually keep that unemployment rate stable. So if you look back to 23, 24, because there was significant immigration into the US, you actually needed, there were entrants into the labor force. The labor force was growing on a monthly basis. You needed 165,000 jobs per month in the US just to keep the unemployment rate stable. Otherwise, unemployment rate is going to rise if you didn't have 165,000 jobs. That has been falling as a result of the crackdown on immigration in the US, as well as the fear of deportation actually chasing a lot of people out of the workforce in the US. And the break-even level of jobs, according to this chart, calling it 90,000 jobs per month, we estimate it to be slightly below 60,000 jobs per month would actually be the break-even level of payrolls to stop unemployment from actually rising. So all eyes on labor data today, but the trend is definitely for a softening in that US labor market going forward. That means that the Fed will be looking to react and reduce policy rates to focus on their mandate of full employment in the US. The inflation side of the ledger is not quite, as positive for the outlook for rate cuts from the Fed. But as we know, at the last Jackson Hole symposium last month, we did hear the Fed talking about a focus on inflation, a focus on labor, and a focus on unemployment, and an expectation that the uptick in inflation as a result of tariffs will likely be transitory. So transitory is back. So looking at various measures that we watch with regards to inflation, if you look to the top left-hand chart, you can see here you're looking at labor data, wage data follows the quits rate and that NFIB data quite closely, and wages is something that drives services inflation quite closely in the US. So as we have seen a moderation in the quits rate and that labor data flowing through into wage inflation, that is going to impact services inflation in the US. Bottom left-hand chart, you can see rentals, new tenants rent leading, and that is likely to drop services inflation as owners equivalent rent, or shelter as they call it in the US, is likely to fall further. You can see Truflation, a US inflation index that looks at underlying detailed drivers of inflation falling to 1.6%. But the bottom right-hand chart, price stats, this is data we receive, which is actually scraped from websites across the US, of retailers across the US. That is starting to pick up, starting to show the impact of the impact of tariffs coming through into US inflation. That is going to be a driver of goods inflation higher in the US. So we have the offsetting environments in US inflation, goods inflation ticking up, services inflation benign, and actually service inflation in disinflation. But that means that US inflation is likely to remain sticky at this 3% sort of level over the next 6 to 12 months. That is an environment where normally the Fed would not be reducing interest rates quite aggressively, but because they are seeing this impact on the labor market weakness from a weakening perspective, the Fed has said we are going to look through this temporary uptick in inflation. So what is priced into the Fed? We expect the Fed to cut interest rates on the 18th of September at the next FOMC meeting. It would take a very strong number today on the payroll side of things in the jobs print today, we think, to change course. And the market actually fully expects it already. So here you're looking at, the market's expectation of interest rates from the Fed. The one thing just to realize here is, at 4.3%, where we currently stand, the Fed is in very restrictive territory. So they are 1 to 1.5% above their neutral policy setting. They have room to reduce interest rates. What you can see is, at April, the market was expecting the green line. At April, the market was expecting a deep, fast cutting cycle from the Fed. Those expectations have moderated. Growth is remaining and performing better than people expected that it would back in April, as well as the fact that we are getting this inflation uptick. That means the Fed may be a bit more cautious in reducing policy back towards neutral of 3%. But ultimately, the market does expect them to be back at 3% by the end of next year. That is a good environment for risk assets. And what I'm showing you here is the differential between investment grade credit and the yield on investment grade credit and the yield on US equities. And in global investment, this is in the dollar space. So dollar investment grade credit, is an asset class that we use quite a lot of in the global diversified income fund to enhance yield in the portfolio. That asset class has performed extremely well over the last 2 years. And what you can see is the reason investors are flocking into investment grade globally is, despite spreads being at quite a tight level, is because yields look so attractive in that asset class. So the green shaded area on the chart is showing you the differential between the yield on US investment grade credit and the yield on the dividend yield on the S&P 500 in black. And as you can see, that is at all-time highs. You're being compensated 4% above, equity dividend yields in very high quality investment grade credit. And for that reason, investors have been flocking into that asset class. We expect that theme to continue as yields remain attractive in the US fixed income complex. But moving into the riskier side of things, so thinking about high yield credit, this is an area we don't think warrants investment in conservative income funds at the moment. What you can see here is the S&P 500 in black, and the spread on the iTraxx high yield credit index in red. So this index obviously a lot more volatile than the investment grade credit index, and what you see here is a much stronger correlation to equities. So, high yield credit in the global context is a lot more volatile, and prices in risks just like the equity market does. Here you can see the reason why the S&P 500 at the highest north of 6,000. Very strong performance in global equities. The same can be said for credit spreads, and high yield credit spreads at sub 300 basis points in the global context, we don't think is a good time to be investing in high yield credit. When I show you the performance or the positioning of the Global Diversified Income Fund, you will see that there is very little exposure to high yield credit in that portfolio. So navigating 2025 from both a global and local outlook is quite tricky, and it all comes down to the politics. We have, in the global context, we still have uncertainty around trade and what that means for various global economies. Always taking Trump, at his word, and not trying to predict, what is happening in those trade wars. To the bottom, a lot is happening in the Russia-Ukraine space, and that could actually turn out positive should we see an end to that war. Positive for oil prices, positive for food prices, which could be quite disinflationary, given Ukraine has such a large impact on wheat prices globally. And then thinking about the local side of things, we've gone through quite a big fight within ANC, within the government of national unity, but we've come through that, and ultimately you need a government for two things. It is to elect a president and pass a budget, and we have now done both of those things. So within the various ministries where all the various parties of the GNU are operating, they can go back and focus on their ministries without having to come together and make a major decision as a government until February next year. The ANC succession battle, heating up, and what we once thought could be quite a viable candidate to replace Cyril Ramaphosa is now clouded in controversy. Senzo Mchunu, under the Mkhwanazi allegations, is probably most likely ruled out as the next president of the ANC, and that that throws that succession race wide open. But more importantly, as we look forward to local government elections in 2027, if the ANC don't perform well there, the ANC succession battle may be quite null and void, and ANC may lose majority in the country as a whole. So a lot to watch, and a very fluid local political environment in South Africa remains a risk for local South African assets. But ultimately, moving back to our core view on South African fixed income is the income protection that the South African government bond market offers you. To the left-hand side, you're looking at the total return of the All Bond Index over the last 8 years. And what you can see is that the majority of your return is income. The black shows you the income return. Red, the negative capital returns, green, positive capital years. You can see that, on average, capital is a very small part or very small component of your total return. Over the last 2 years, we've had a very strong bull market post the formation of the GNU and that positive political event that we had in South Africa, the reform momentum that is expected to continue, and the tail risk of, a populist government being taken out. We've seen very strong returns from South African government bonds. So where do we sit today? 10-year yields are still at 9.7%. So even after double-digit returns last year and almost, close to double-digit returns year to date, 10-year yields are still close to 10% in South Africa. Inflation is expected to average 3.4%, and even on a forward-looking basis, our average for inflation next year is very close to 4%. That is a 6% forward real yield in South African government bonds. That is a very attractive proposition. And relative to cash rates at 7%, you are earning attractive enhancement relative to cash. Our emerging market peers, we are a high yielder in that complex, so we offer your global emerging market investor a pickup to that index, which currently only yields 6% because of the likes of Asia and the Middle East that form part of that index being low yielding, and relative to our high yielding peers, the likes of Mexico, Brazil, Turkey, we are actually the positive story in EM at the moment. We have changed our inflation target. We are being prudent in our fiscal management, and we have a very attractive yields on offer in South Africa with strong reform momentum coming with us. So that brings me to portfolio positioning. In the last few minutes of my presentation, I'll briefly touch on the local diversified income first, and then touch on the global diversified income fund. The local diversified income fund made up of 56% high quality local investment grade credit. We prefer low risk sectors like banks, insurance, real estate, telecommunications. These are blue chip counterparties with very strong balance sheets, very strong cash flow generation, and good management teams managing those. Utilities make up a big portion as well, and those are predominantly government guaranteed exposures. And on average, the credit spread of that portfolio enhancing yield by north of 1.5%. A very attractive asset class, low volatility, low credit risk. From an asset allocation perspective, we are overweight government bonds. So we see, strong returns for the bond market on a forward-looking basis, very attractive yields, and three things, driving our view in South African government bonds. It is the lower inflation target is not fully priced in longer dated yields. We have prudent fiscal management, primary surpluses forecast amidst, strong reform momentum in government, as well as the very strong valuation case in the asset class, which is why we like South African government bonds. Relative to local property, actually offering better yield. So we are underweight property, overweight government bonds. And as I mentioned earlier, from an FX perspective, we, it is a very positive environment for the Rand amidst a weak dollar environment. So we are underweight our offshore exposure in the portfolio. The portfolio yields 9.5% or close to in rands, and bear in mind, should it looks like we are very underweight FX, but the portfolio has built-in protection strategies, and we are very focused on protecting capital in this portfolio, and those being downside protection on government bonds, upside in dollar rand, and should we get instability in the local South African markets, those stabilizers in the portfolio will kick in very quickly to protect capital for the portfolio. Moving on to the Global Diversified Income Fund, a very well-diversified global portfolio. We are neutral duration at 1.5 years with, the US rate cutting cycle quite well priced. We are overweight developed market credit and underweight emerging market credit, neutral credit at 50% overall, but fully investment grade. The underlying portions of that credit portfolio are quite defensive, and I'll talk to that in a few slides' time. Our duration makeup, to the top right-hand table here, is predominantly made up of US duration at the moment, but we also see very strong opportunities in New Zealand and the UK. These three economies are the economies that have cut interest rates late and have room to ease policy further, and their bond markets will benefit from that. The likes of Europe, the likes of Canada, for example, have already reduced interest rates, and there isn't much further for them to do. We hold some small overweight dollar positions in this portfolio relative to the euro and the pound sterling as a diversifier to reduce volatility in the duration risk of the portfolio. And then finally, to talk through our credit portfolio, extremely well diversified credit portfolio, pretty much fully investment grade. Diversified across 30 countries, across 90 counterparties for a 50% allocation, managed within the 91 global credit strategies. Thank you very much for your time. I think my time is up, and I'd like to open to any questions you may have at this point.
Adam, thank you so much. That was a very comprehensive view of fixed income across the world. Some good highlighting some key things to look at. While we wait for some questions, I'll kick off. But as a reminder, if you have any questions, please pop them in the chat box. We'll address them. But maybe to start, just on the global bonds, and I guess specifically given US duration, looking at US bonds, you mentioned, the view on lower rates, inflation is likely to be transitory, and there's rather going to be a focus on the labor market. So we've got support for bonds from that kind of perspective. But how do you kind of position that against the large issuance pipeline and the building debt risk or the fiscal risk?
Yeah, no, that's a brilliant question, Eben. And something markets are grappling with, as we speak. We are seeing a big underperformance in longer dated US fixed income assets relative to the short end of the curve, which is much more reactive to the monetary policy outlook. So firstly, to be clear, in the Global Diversified Income Fund, that duration positioning is kept very short in the 2 to 5 year sector of the curve, less impacted by issuance dynamics in the US. And then, looking at, the general view on longer dated yields globally and the debt burden that is, approaching and likely to impact that US economy. You're 100% right. There will need to be, issuance increases in that U.S. economy, and we know one thing, and it is what the U.S. Treasury has told us. Scott Bessent has said he wants, longer dated U.S. yields lower. So, what are the, and what is his avenues to actually do that? It is likely to reduce the issuance of longer dated U.S. assets. Is likely going to be reforms to the regulations, banking sector reforms, potentially even pension sector reforms that may increase the attractiveness of investments in longer dated fixed income securities for those sectors, or increase their capacity to own those sectors. That will definitely add to demand there. But ultimately, it is a very fluid environment. And as we currently stand, the US is running an expansionary fiscal policy in a period where growth is holding up okay, which ultimately should mean yield curves continue to move steeper. A lot is already in the price at 5% in the 30-year US yield. So, bear that in mind, where yields are at extreme levels already. And, ultimately, the US is still the largest economy in the world. They still have a very well-diversified economy. And what we have seen is that the economy can actually withstand very high levels of debt. If you think back to 2022, when rates were hiked very aggressively up, north of 5% in the US, we all expected something to crack, something to break, and that to cause a recession. But ultimately, that economy held up very well. They continued to, perform very fine. There was some small regional banking issues as a result of those higher levels of rates. But ultimately, the economy has shown resilience for these high levels of rates, despite the high debt burden it has, and that means that they are able to manage and operate at these current debt levels.
Okay, maybe just staying on rates. Just want to get your view on the whole central bank independence view topic. And so, obviously, the firing of these could probably just applying a bit of pressure. Just maybe your view of where that could end. And then also with Powell's term up in May next year, they're probably not going to go through this whole of making noise if he's not going to get someone that is actually going to aggressively cut rates. So if we get into that position, where can rates end? Could it be to the detriment at the end for the market, or what you view?
Yeah. So again, I mean, the US, the federal independence, is definitely under attack, and it is clear for everyone to see that Donald Trump is actively using the DOJ to target various Fed members and impact and stack that committee in a partisan manner. What does that mean looking forward? It means that the shape of the committee is likely to move more dovish. There are going to be people that prefer, lower rates in that committee. As you say, Jay Powell, his term comes up next year. Governor Waller is a likely candidate for his replacement, and Governor Waller has been one of the outspoken members calling for lower rates in the committee, despite the forward-looking outlook for inflation. And that made the market think he is a Trump-influenced Fed official. But if you actually go back and look at his arguments and the way he looks at the labor market and the way he thinks about the economy, they were very economically sound. And ultimately, there are checks and balances in who can be appointed to that committee. It will be driven more dovish, by the current administration. But ultimately, we actually have an ex-central banker sitting with us here at 91. His name is Brian Kahn, and he says, once you get, whilst you may be campaigning for your job, talking rate cuts, etc., once you get into that SARB or into that federal, building, you feel the weight of an economy on your shoulders, and you feel the responsibility, and act in a manner that that is warranted by that. So definitely a space we are watching very closely. Governor Waller, we think is not a crazy choice for central bank governor. So not a concern to that extent that you may see completely unorthodox policy, but definitely the subtle shift in the committee will be to the dovish side. And that is definitely something that is going to, or that has currently added to the weakening pressure on the dollar, as well as the raise in longer dated yields.
Okay, thanks for that view. And maybe end off with one last question. I'm very glad you gave the SA view first as well, just to put the perspective from looking at yields globally as well. So I mean, we've seen that foreign investors have slowly started to come back to South African markets. June, July was pretty good months, if I'm not mistaken. And our spreads have come down quite a bit. So there's a lot of positive momentum, and you showed a lot of those factors, that's pushing yield a bit lower. And we've caught up some of those capital returns that we've missed out on over the past few years. But given the picture on global growth, so some of those major economies that are now slowing, typically a better environment for bond markets, we've shown that the yields are very attractive globally. What's the risk that we actually see some of those capitals with flows reversing? So markets rather chasing the attractive hard currency yields than markets like South Africa.
Yeah, I mean that is definitely a risk to South African assets. When we evaluate, flows into the emerging market asset class as a whole, it actually has been an underperformer over the last 5 to 10 years. Emerging markets, particularly post-COVID, have not received the amount of flows that the likes of high yield credit or investment grade credit in the US or globally in hard currency have received. So I wouldn't say the EM complex in general is an over-owned asset class. So there is room for allocators to add to EM. I don't think South Africa is a massive overweight in the global context, and there is still room for investors to add to us relative to other emerging market countries. So ultimately it will. I don't see a massive risk of outflows due to heavy positioning, but ultimately I think what is the major positive for the emerging market asset class in the current environment is the weak dollar environment that we find ourselves in. And because we've been in a strong dollar environment over the last 10 years, emerging market bond markets, despite offering very attractive yields to a global investor, to a global dollar investor, he's actually had a lot of that yield, taken away from him by currency depreciation. Now that we find ourselves in a differing environment where the dollar is not a one-way bet, stronger, that actually makes emerging markets, local currency bond markets look quite attractive as a diversification for global investors.
Yeah, very good points. Okay, I think we'll call it there. We're almost out of time. So just want to say thanks to everyone for joining, and Adam, especially to you. Thanks so much for your time this morning. We really appreciate it. For that great view and comprehensive view of local and global fixed income markets. If there are any questions following this session, you're more than welcome to send them through, and we'll pass them on to the 91 team. Apologies again for the technical glitches this morning. We are going to have the recording available afterwards as well to everyone in the group. All right. Thanks, everyone. Have a great weekend. and we'll see you again at the next session. Thanks, Adam.
Thank you.